Hey everyone, I'm Ishan Sharma, and in this video we'll be talking about mutual funds. We'll discuss everything that I have learned in the last 9 months, and we'll be talking about what is a mutual fund, what are the different types of mutual funds, how can you invest in mutual funds. We'll also look at the basic terminology that you should be aware of, the taxes that are levied on mutual funds, and a lot more. The timestamps are given. Make sure that you use them if you want to. And let's get started with this video. Nothing that I say in this video should be deemed as financial advice. I am just a 20-year-old guy talking about things that I have recently explored in my life. That being said, let's talk about mutual funds. What is a mutual fund? Mutual fund is basically a basket of stocks or other assets, right? You can invest into a mutual fund if you don't have the time or you do not have the expertise to pick particular stocks. Now, mutual funds are run by asset management companies. These are big fund houses, like you have Access mutual funds, you have HDFC mutual funds, you can have Parag Parikh mutual funds, Mirai Asset mutual funds, and a lot more. What they do is that they have a team of people who are experienced in this field. They know how to pick great stocks. So what you do is you basically just say that, hey, I have this amount of money lying around in my bank. I might as well just give it to you, and your job is to find value in the stock market and invest properly and give me the returns. And they deduct a small fee that they take as commission. That is the whole idea of mutual funds. Now, this is actually really interesting. If you go online, if you search for mutualfundgalathai.com, it will actually redirect you to mutualfundsahiya.com. You might have also heard this thing that mutual fund investments are subject to market risk. What does this mean? Basically, mutual funds are going to be investing your money into the share market, into the stock market of India or elsewhere. But what they are telling you is that they don't guarantee you returns, okay? They have a past performance, they have their expertise, but they don't say ki, hey, we will guarantee you returns. You will always get this amount of return. No, they don't say that. And your amount that you have invested can go down as well. So just make sure that you're aware of that. Now, one thing to understand when we are talking about this is the rule of diversification. Whenever you are investing in a mutual fund, you are diversifying your portfolio, your basket of stocks, because when you invest into one mutual fund, they are investing into multiple stocks, multiple assets. Now let's talk about the different types of mutual funds that are available. Now, first of all, there are a lot of different categories based on which you can categorize them, right? First of all, let's talk about passive versus active mutual funds. If you look at passive mutual funds, for an example, we can take a look at the passive index fund. In this case, what happens is that the fund manager doesn't actively need to research about the market. They don't need to have a huge team of researchers thinking about where to invest, which stock will have value in the future. They basically look at the index, right? That is the Sensex or the Nifty 50, and they try to track the index. They will basically be buying all the stocks that are in the top 30 companies of Sensex or the top 50 companies of Nifty 50. That is basically how this thing is supposed to work. So because you don't have to put a lot of effort in finding out value in the stock market, they charge you a lesser fees when you compare it with actively managed funds. And now if you look at the actively managed funds, these funds will basically be having a lot of people who are experienced, and they will try to find out value in the stock market. So their whole goal is to find out value, and they research thoroughly, and then they try to invest your money. That is the whole idea about passive as well as active mutual funds. Now let's try to also categorize mutual funds based on the direct mutual fund or the regular mutual fund. Always keep in mind that the regular mutual funds will be having some hidden charges, and so they will basically be costing you a lot of fees when you compare it with a simple direct mutual fund. So it makes a lot more sense for you to invest into a direct mutual fund and not a regular mutual fund. Now let's talk about how to invest in mutual funds. So you can use the Finity application if you want to invest into mutual funds. The way this works is that it is a completely online platform that you can go to. You can look at different mutual funds and you can start investing into direct funds. It makes it easy for you to start investing into mutual funds without having to worry about transparency as well as security. The sign up process is quite simple. You will basically have to verify yourself using KYC. You'll get a simple OTP. You will verify that. After that, you will have to enter your PAN number, your address, your Aadhaar card. And once that is done, you will be ready to invest on the Finity platform. There are over 5,000 different mutual funds available on the Finity application that you can go on to, and you can start having a detailed analysis of all of them, and you can choose for yourself which one would you want to invest into. They also have a smart recommendation engine that will help you understand what is it that you should be investing in. They also have easy payment options, so you can basically invest using UPI or NEFT, and all the transactions on the Finity app is secured using a 256-bit SSL encryption. And Finity has also partnered with Money Control as their official mutual fund management partner. You can download the Finity app by the link in the description, and you can start investing into mutual funds, passive or active, whichever one you want to go ahead with. You can also try to categorize funds based on where they are actually investing. If you look at large cap mutual funds, these funds are only investing into large cap companies. They are buying stocks of large cap companies. Large cap companies are the companies that have the market capitalization of over 20,000 crore rupees. Then if you look at the mid cap mutual fund, these basically invest into companies that have a market capitalization of over 5,000 crore rupees to 20,000 crore rupees. That's how that works. Then of course, if you look at the small cap mutual funds, these are basically investing into companies that have a market capitalization of less than 5,000 crore rupees. So this is basically how it works. Then you have mutual funds that either invest into equity, so they are called as equity mutual funds. Then you have mutual funds that invest into debt. They are called as debt mutual funds. Then you also have certain mutual funds that invest into overseas stocks. Okay, for example, you have Parag Parikh FlexiCap. They invest into US stock market, into companies like Apple, Microsoft, Google, and Facebook and all. So that is how that works. After that, you also have thematic funds. These funds invest into particular themes. For example, pharma sector, or you have technology sector. Both of these sectors have boomed in the last 1 year. So if you would have bought them early, you would have made a great return on your investment. But of course, this depends. You have to be very careful with this. You have to make sure that you are aware of the companies that these mutual funds are investing into. By the way, if you are enjoying this video, make sure that you hit the like button and share this video with your friends. Let everyone know about mutual funds and how do they really work. Also, you can subscribe to this channel. I make a lot of different videos around investing as well as career and freelancing, so you can do that. Now, I read somewhere that the average Indian investor invests into 35 mutual funds. One mutual fund is already diversified and they're investing into 35 different mutual funds. That was just crazy for me to even look at. Now let's try to understand what are the basic terminologies that you should be aware of. First of all, you have something called as expense ratio. Expense ratio is basically the expense or the fees that they levy on you for getting you the returns. So the way this works is that depending on what is the AUM, asset under management, these fund houses have a limit of having this amount of expense ratio. As you can see on the screen, you can understand if they have a AUM of, let's say, 2,000 crores, or if they have a AUM of 10,000 crores, how much expense ratio can they charge? You can look at that. Now, to understand how important expense ratios are, let's take a look at a simple example. Let's say you invest 1 lakh rupees into a mutual fund that in the next 1 year gets you a 5% return on investment. Then it says that it will deduct 1% expense ratio. Then let's say you have another mutual fund in which you also put 1 lakh rupees and in the next 1 year it got you the same 5% return. But this one is charging 2% expense ratio. At the end of the 1 year, the first mutual fund would have gotten you 1 lakh 5,000 rupees before the expense ratio that they charge. After that, the second fund would have also gotten you the same amount, 1 lakh 5,000 rupees. But the fees would be different, right? From the first mutual fund, they'll be charging you 1,000 rupees. That is the 1% of the 1 lakh rupees that you have initially invested. For the second mutual fund, they will be charging you a 2% expense ratio on the 1 lakh rupees that you have invested. That would be 2,000 rupees. And that is how your mutual fund returns can be varied depending on the expense ratio. Another way to understand the long-term impact of expense ratio is, let's say you invest 10,000 rupees into a mutual fund that gets you 10% return on an average yearly. And so after the 20 years, you would be sitting at about 46,000 rupees if the expense ratio was 2.5%. Versus if you would have invested into a mutual fund that would have charged you 0.5% expense ratio, your same 10,000 rupees would now be worth 61,100 rupees at the end of the 20 years. So you see there's a huge gap. When you invest for the long term, you have to make sure that the expense ratio is small or it is comparatively smaller. So just make sure that you are aware about that. These expense ratio hote hain, these might seem small to you, like 1%, 0.1%, doesn't really matter, but you need to be very much careful about all of these things. Okay, don't take it lightly. This can literally make or break your returns that you are getting. Okay, so make sure that you are aware about this. Let's move on to the next part and let's look at risk. So there are different mutual funds that operate on different levels of risk, right? You can look at where they are investing to get an idea of what is the risk of the investment that you are doing. There are mutual funds that are extremely safe. They will not invest in anything that is less than blue chip. And then there are ones that go all in. They have the freedom to invest in whatever they want to, but then they are also the ones that get some crazy returns. But one thing to understand is that around 70 to 80% mutual funds that are actively managed are not able to beat the index funds that you have. So that is an interesting observation that you should always keep in mind. And of course, they charge a higher expense ratio to you as well. One more thing is the SIP and lump sum format. So what you do is you can either invest a small amount every single month, or you can invest a lump sum amount at just one point and you can just let that be it. Now, SIP or systematic investment plan is a way for you to invest in mutual funds or stocks in which you don't have to worry about timing the market. You would basically just say that I will invest a particular amount, let's say 10,000 rupees on a set date every single month, and I will continue doing that for the long term. In this case, your goal is the long-term capital appreciation of the investment that you have made. This is basically what SIP is about. You are not worried about the current market volatility. You are looking at the longer time frames. Then you also have lump sum format. In lump sum format, you basically just say ki I have this lump sum amount and I will just invest it at one time itself. That can have some problems, that can have some benefits as well. So you are free to research about how that works. One more thing to understand is the concept of exit load. So the way exit load works is that whenever you want to withdraw your investment along with the returns that you have generated, you can be subject to an exit load. They can basically just say ki we want to get an exit load from you. That can be like a 1% or like a 0.5% rate that they have set, and that is how much they will take out from your total return on investment. Now let's talk about the taxes that are levied to you when you're investing into mutual funds. First of all, you have a short-term capital gains and then you have a long-term capital gains. Capital gains basically means, let's say you invested 100 rupees and now that amount is 110 rupees. So that 10 rupees that you have is your capital gains that you have had. The best part is that if your capital gains is less than 1 lakh rupees, you are completely tax exempt from that. For example, let's say you invested 10 lakh rupees into a mutual fund and right now your capital gains is 90,000. Okay, you are able to make 10 lakh 90,000. So now your return is basically 90,000, which is less than 1 lakh rupees. So you will not be having any taxes on top of that. And now if your capital gains is more than 1 lakh rupees, you have two types of different taxes. You have a short-term capital gains, then you have a long-term capital gains. Short-term capital gains happens if you hold a mutual fund for less than 12 months, right? Less than a year, then you will be levied about 15% short-term capital gains. It can vary, but generally it is about 15%. The next type of tax that can be levied is called as the long-term capital gains tax. This is what you have to pay if your capital gains is more than 1 lakh and you have held on it for more than 1 year or 12 months. Okay, that's basically what you need to understand. How much it is? It is about 10%. Okay, it can vary depending on what mutual fund you have. Generally, it is 10%. So with that said, we can also look at the holding updates. Basically, whenever you buy a mutual fund, you'll be getting emails every single time. There is basically a rebalancing update or whatever stocks they are selling, buying, whatever updates they have, they will send you an email. I get tons of emails every single day from my mutual fund houses that I have bought mutual funds from. Okay, so that's what you need to understand. Now let's look at the mutual funds that I like to invest in. The first mutual fund will be Parag Parikh Flexi Cap Fund. This is the first mutual fund that I invested in my complete investing journey. I really like how they invest into US stocks as well, and the returns have been great as well. Second is HDFC Index Funds. I personally invest into the Sensex plan. So basically this is me investing into a passive index fund, and it has a very low expense ratio. That is also a good thing. I also invest into the Nasdaq FOF. It is a fund of fund by Motilal Oswal. Third is the Mirai Asset Tax Saver Fund. That's what I invest into to save tax. Basically, using this ELSS scheme, you can invest up to 1.5 lakh rupees every single year, and you can save up to 47,000 rupees in taxes every single year. So that is a great thing that you can do. But that's pretty much it, guys. I also invest into some thematic funds like the ICICI Prudential Technology Fund and the Nippon India Pharma Fund, but that's pretty much it. I only invest into like 4 or 5 funds. Thank you for watching this video. I hope you got to learn something from this. Let me know in the comment section if you're still watching this. I don't think that anyone would have the patience to watch this complete video. It took me a lot of time to research this, and I hope this was adding some value to your life. You can also follow me on Instagram at Ishan Sharma 790. Hit the like button, share this video with your friends, subscribe to this channel. I also have a great community that you can join called as Market Up X that will help you to become a better freelancer and just basically grow in your college life. You can also take a look at the Finity YouTube channel if you want to learn more about investing. And yes, you can download the Finity app from the link in the description. Thank you for watching. I am Ishan, and I will see you again in another video.